Hello, and welcome to myfinanceteacher.org. In this video, I want to talk about the fundamentals of the uranium market. We also will have a look at the technicals of the market, and we'll also have a look at a couple of interesting companies, Cameco and Energy Fuels. First of all, let me thank the member at myfinanceteacher.org who suggested that I look at the uranium market fundamentals. They do seem very interesting, especially in the longer term. Secondly, if you're watching this on YouTube, perhaps after uranium has already produced very interesting gains, and if you want to have timely access to my analysis, why not join us at myfinanceteacher.org? You can join by clicking this register button. The first month is only $5 and it's $10 per month after that. Next, let's have a look at the uranium fundamentals, looking at the demand and supply picture. Starting with the demand of course would be generated by these nuclear power generators. According to World Nuclear Association, there are currently 444 of them, with another 54 under construction at the moment, another 111 planned coming up in the near future, and another 349 proposed in a more distant future. One thing that is not actually shown here is how many of these power generators, how many of these power plants are going to be retired over the next few years. Here, this next graphic comes useful. That's from UXC. Here we see that over the next few years, actually the total capacity doesn't really change that much. And although there are a lot of power generators under construction and planned, the number of those generators doesn't really change that much either. Over the next 15 years, as you see, it's expected to increase from around that number 444 to somewhere around 485 or so. That's of course due to the retirements over these years. Mostly, as you see at the bottom of the chart, there will be retirements in North America and Europe. Nevertheless, although the actual number of power generators is only going to change from around 450 to around 480, so that's not a very substantial change, the total generating capacity beyond 2025 is actually going to increase from the current 400 megawatt capacity to around 450 megawatts. So as I've just mentioned, the market fundamentals do look quite interesting, but in the longer term. Those upcoming generating capacities are expected to create demand for uranium of around 200 million pounds, according to URNM. And as investors, you want to balance demand with supply to see what might happen to price. And also according to URNM, uranium supply, including current and prospective mines, is around 170 million pounds. It's stated that the shortfall in supply more recently has been covered by the reductions in inventories. Of course, inventories can't continue dropping forever. At one point they might go down to nearly zero, in which case the supply shortfall might actually positively influence the uranium price. One thing you might point out here is that there is a uranium price and there is a uranium price. There is a spot price and there is a long-term price paid by those nuclear power generators to the miners. And in that respect, if you have a look at this graphic, you will see that according to UXC, it looks like more and more of the supplies are going to be purchased based on the spot price rather than the long-term contract price over the next several years. And in either case, as you would expect, the spot price, blue line over here, does tend to be relatively close to the long-term price, which is the gray line on the chart. The only exception here over the last 20 years is whenever the spot price skyrockets into unimaginable heights, the long-term contract price often doesn't follow into those heights. For now, though, uranium prices are far from being high, so whether you're looking at spot price or long-term contract prices, the industry fundamentals over the long term do look very interesting. Next, moving on from fundamentals to the technicals, let's finally have a look at this chart that we've seen on the background. And that is the chart of the uranium prices. I think many would agree now that at the end of 2016, we've seen a new bull market starting in uranium prices. That's when the downtrend has actually been broken. And the way I see the market cycles is that on average, since the beginning of this bull market, it seems to me that the cycles last for around half a year, with the last one being unusually long. Additionally, the beginning of that previous cycle saw really nice gains in uranium prices, which means perhaps the gains in the ongoing cycle might actually be relatively muted to give us some sort of a consolidation area. Talking about the current cycle, it's now 75 days long. Usually these cycles last for around half a year, so there is still enough time for this cycle to give us noticeably higher prices before some sort of a correction. One negative point so far is that the price stays below the 50-day moving average over the last few days. Once the price recovers that 50-day moving average somewhat convincingly, I think there will be a nice noticeable rally since the 14-day RSI is pretty low. And perhaps the uranium miners are indicating that the price is getting ready for that rally. So let's have a look at those miners, starting with the URA, the Uranium Mining ETF, which has been declining since the beginning of this year. And after retesting the 50-day moving average on Friday and retesting the lower range of the Bollinger Bands for several days, we've seen a nice bounce in the URA. And if this rally continues, the next resistance zone to retest would be these highs from early 2017, somewhere around $18 to $19. And your risk level will be breaking below the most recent lows on Friday. So once the markets open in the US, if I see a green candle, I might actually get myself some URA and URNM. Talking about URNM, let's have a look at URNM. A similar picture here, a retest and a slight poke below the lower Bollinger Bands, and it came relatively close to retesting that 50-day moving average. One concern though on URNM is that it didn't really close that gap from December last year. But with the uranium price cycle still relatively early, and with RSI coming down to 44 on Friday and still being far from oversold, I think there is still potential for further gains, with a relatively small risk of closing this recent gap. So you probably have to see what happens on Wednesday before you make a decision. Next, let's have a look at a couple of large uranium producers. We'll have a look at their fundamentals, where we're going to look at discounted per share value of the resources in the ground after extraction costs and after debts, with a bit of a secret sauce on insider shares. So starting with Cameco, Cameco has 461 million pounds in proven and probable reserves and 424 million pounds in measured and indicated resources. The costs per pound for Cameco are $26.3, and the long-term debts make up $770 million. At current annual production, the mine life for Cameco is 16 years. Although current annual production is probably not a best indicator, as currently a lot of the mines are on hold. Still, with current annual production, the mine life for proven and probable and only half of measured and indicated resources would be 24 years. The discount rate I will use is 5%, and the company has nearly 396 million shares outstanding, out of which 0.17% are in the insider hands. This time, as opposed to my previous look at Cameco, I bumped up the uranium prices according to the market fundamentals. Let's consider the current price as the conservative one at $30, since at current prices, producing uranium is unprofitable for many of the former miners. World Nuclear Association and URNM actually expect the price around $50 to $60 per pound on uranium over the next couple of years. So let's say our balanced price is just below that lower threshold of $50. Let's say our balanced price is around $45. And our optimistic scenario is only at the top range of that expectation of $60. That would give you a per share value of $2.61 of Cameco. That's including about $1 for their fuel services, which is still quite far below the ongoing market price around $13. The balanced valuation would be $14.41, which is relatively close to that market price of just under $14 as far as I remember. And optimistic valuation in this case is over $33 per share. So now with this new look at Cameco, with a new view of fundamentals in the longer term, if uranium prices go up to $60, these uranium miners do look quite attractive. On the other hand, if prices stagnate over here somewhere around $30, then there is potentially further downside risk on these uranium miners. Next, let's have a look at Energy Fuels with their proven and probable reserves of 19.1 million pounds and measured and indicated resources of 58.9 million pounds. Let's assume the costs of $26 per pound because I didn't find this information. These costs are somewhat similar to those of Cameco. Energy Fuels only has about $500,000 in long-term debts, and their mine life would be around 5 years for proven and probable reserves and 13 years for proven and probable, as well as half of measured and indicated resources. By the way, balanced and conservative valuations only include the value of proven and probable reserves without looking at measured and indicated resources, never mind inferred resources. So although I call it balanced, even the balanced valuation is probably leaning quite a lot towards conservative one because we're not even considering some of the resources in the ground. And even in the optimistic scenario, we only include half of the measured and indicated resources. Moving along with Energy Fuels, they have over 134 million shares outstanding, out of which 1.57% are in the insider hands. All of that gives you a valuation of only about $0.50 per share in the conservative case, which is far below the market price of over $4 as far as I remember. The balanced valuation is still below the market price at $2.35, and the optimistic valuation is nearly double the market price at nearly $9. And in addition to the valuation predicted by this model, Energy Fuels have also started producing rare earth elements in the first quarter of 2021, and they do have some copper as well. So perhaps these sideline businesses would add to your valuations. And that concludes the video. Hit the like button if you want the uranium prices to shoot up to $40 next week. Share your opinion in the comments below, and good luck in your trades.